Hi, I am Subrato Hansda, an associate in Third Eye Advisory, and today I will be talking about some of the basics of capital structure and the cost of capital. So for any company or any business or any industry, there would be a need of capital at some or the other point of time. So how to raise this capital, whom to approach and where to go? There are various sources of finance, by the way. One can go to the banks, one can go to the financial institutions. There are various schemes by the government for direct assistance, and there are angel investors and venture capitalists. But the question here is how to get them interested in your venture, how to convince them. The answer is through financial statements. By financial statements, I mean balance sheet with convincing projection of your future and the business. The promising profit through income statement, and third would be healthy cash flows. Now let's keep the thing simple and consider that for any company, this capital structure comprises of either debt or equity. So what is this debt? Debt is nothing but the mode of raising the capital by which company issues the bonds or securities to the debt holders in return of the funds, and on top of which company pays the interest to the debt holders. And this interest that the company pays to the debt holders is going to be the cost of debt for the company. But then this cost of the debt is going to be differed in various cases. Let's consider the case of bonds. So company, if issuing this bond at par, then the interest is going to be the cost of debt. But when the company is issuing the bond at discount, then the cost of debt is going to be higher. But then when the company is issuing this bond at premium, then the cost of debt is going to be lower. So we can say that debt is nothing but an obligation, a liability that company has to honor in any case, irrespective of the profit it earns. Now consider the case of equity. Equity is a mode of raising the capital wherein company changes or issues the shares and there is a change of ownership. Now consider that the one who is having the highest number of shares is going to be the one with the highest amount of ownership, and there would be the case of dilution or concentration. By dilution I mean then that there is a dilution means the change of ownership, there is a decrease of ownership, and by concentration I mean that there is an increase of ownership, that the company repurchases the shares. But then the equity again is having a cost associated to it, and the cost of equity is nothing but the dividend that the company plans to pay to the dividend holders or the equity holders. And now if we say that this cost of equity depends on how the company decides to pay the dividend or how the company is performing. Now we can say that cost of equity is nothing but the minimum expected dividend that the investor or the person who is giving the finance expects. And overall, if we sum up this basics of capital structure and the cost of capital, we can say that this is a decision which is very important for any company, as it involves cost, the going concern, a long-term perspective, and the wealth maximization of the shareholders, and of course there is a time value of money associated to it. Thank you.